Alright. Hope everyone is having a great start to the morning or afternoon, depending on when I finish this. Anyways, it's probably about an hour before the market opens, and so with that said, I apologize in advance if I may have to stop this video off and on and stop the recording off and on. So I apologize in advance if it seems like it's skipping around at times, but I'm going to try my best not to let that happen. Anyways, so I've been asked a few questions over the past few days. One being, well, two questions. This is going to be a kind of just a real quick answer of these two questions, and one being, how do you distinguish tight channels versus trading range legs? And this person's basically asking, how do you trade them with wide stops, or excuse me, with tight stops? In a trading range, the market's constantly creates two-legged moves up and down, and in a tight channel, the market's constantly forming wedges, low twos and low fours. Also, for tight channels, if you look, this person says, if you look far enough to the left, it will always be around some support or resistance level. So they're asking, how do you, and I guess what they're asking is, how do you characterize them, recognize them, and then how do you trade them differently? Well, that's a good question. And, everything has to do with the market cycle. You get, so let's review that real quick. The strongest part of the market cycle is a breakout. It's right here. That's a breakout. And at that moment, breakouts are, think of it as 10% of the time in the market where, there's over a 70% chance of more down. In other words, it's a moment when 10% of the time it's going to be really hard to fade. So let's find an example. It's kind of like, it's like buying as this is happening. It's going to be really hard to make money. Now, obviously, if you bought down here, you could have made money, but it's kind of, or if you're selling during these bars, it's going to be very difficult. Therefore, you should only look to buy at that moment. I'm trying to find a really strong. Yeah, so kind of like this. Very strong bear breakout, and you're just going to get killed if you're buying. I mean, you really are, because they're very hard to manage, and you miss out a lot. So one thing I want to start with that is having the ability to trade small. I've been saying for the past few days I've been highly recommending, for someone who's wanting to feel more comfort or really have the ability to trade the I don't care size, I've been really recommending switching to the Spider, which is an ETF, or switching to some sort of forex market. And the reason is exactly this. If you're trading the ES right now and you sell this close, you've got to risk 7 points to this high. So when you're down here, your stop's still all the way up here, and that's over 10 points. And just most traders just can't do that. A lot of traders starting out. But if you're trading something like the Spider, if you know you need to get short, just trade 100 shares, put your stop up here. Sure, you're not going to make a lot, but you're in the market. You're at least going to make something. It's better to make something, even if it's a small number, than make nothing. And you won't be as worried. So let's start with real quick. Let's look at a Friday. Maybe I think it was, right here on the 9th of September. So this is what I would call pretty much a tight channel. It's hard to actually. I'm gonna have to do some adjustments here. So give me one quick second. Okay, so I don't even know, we don't even need to know. You really don't even have to look to the left. I mean, I do all the time, but let's just, for simplistic sake, we have a gap down. Okay? So we see, okay, trading range, gap down, and we get a bear bar closing when it's low. Well, at this moment, I'd be thinking, I wouldn't sell because I would be hoping for some sort of decent bull bar closing when it's high on bar 2 and a chance to buy to the moving average, because that's usually what happens. Didn't get it always in short. Well, so what about buying above bar 3? Well, probably not. Probably sellers above, bad signal bar. So probably going lower. And there's your first, I'd say, decent stop entry short. But anyways, my whole point with this is just if you want to be always in, or if you want to swing trade, sell below, put your stop above, because you know this. We may, it's tight channel, and the odds are if we get to the moving average, we'll continue to go sideways to down. But if you want higher probability, at some point, just get short. One second. Yeah, so, at some point, just sell. And one of the reasons tight channels, as I said, is really difficult, or breakouts for that matter. A tight channel is simply a breakout on a higher time frame. This is consecutive bear bars, I think, on a 15-minute chart. I haven't looked, but I'm pretty sure it is. One of the difficulties with tight channels and breakouts is the risk is big. And this is why it's effective. It's much more effective to be able to trade small than it is to trade only a couple contracts in the evening. I say that because for most people, if they're trading 1 or 2 contracts, they are, number one, even if they want to scale in, it's very difficult. But if you're trading Forex or an ETF, I mean, you can scale in. You have you have just a ton of flexibility. One thing I do that I've started doing now is, I've been doing a lot the past about a week or so. Whenever the market's going down in a tight channel, and I know it's clearly always in short, but my thought is, well, I don't want to buy all the way at the bottom. I think we're going to get a pullback. So what I'll do is I might buy or sell depending on the way it's going down. So I'll use this example. Markets, let's say, all the way down here. I'll sell a 25% position. I'll just sell at the market, put my stop up here. That way, at the very worst case, for some reason, if I don't add on, I'll be in the market and I'll get something. Even if it's not a lot, and it'll keep me from buying. And if I get the opportunity, I'll try and sell more higher, which you could sell more up here. So my first question for this person would be to ask, are you trading too heavy of a position where you don't want to risk a lot? Because you say in your question that you say how to distinguish or trade them with tight stops. Well, my first question for you is, do you always use tight stops? You have to remember this. Everybody's starting out, and this particular person, I have no idea if they're starting out or not. They've been doing this for a while. So they're not really starting out. But, for everybody, I would say be careful with tight stops. You always have to remember, yes, everybody wants to risk the least amount as possible. But the reality is, it's not the best way always. If let me just pick an example. This happened earlier. Here, okay. Let's say I sell down here, and I put my stop above here. Well, sure. Some would argue that's a tight stop. The correct stop's up here. And I get stopped out to the tick. Or, This kind of thing happens a lot where price will go above your signal bar. So maybe you sell it below this bar, and then you say, okay, got an entry bar for my stop. I want to take above the entry bar and you tight stop. Well, you got stopped out here in this bar. So sometimes tight stops aren't always the best. If I was gonna recommend how to do it, use the wide stop. Wherever I'm selling, if I'm selling even at the low close of this bar, my stops up here at a minimum, maybe at the high of the day. Now, I'm gonna plan on never letting that get hit. I'm gonna use what Al says all the time. It's a catastrophic stop for whatever reason. Your internet goes out, an emergency happens, or trade station stops working or something. You at least have a stop in the market. If I'm selling this close, if I'm selling this breakout, my stop goes maybe up here, probably up here. If I'm shorting this second entry short, I say, yeah, second entry short, high probability. It probably is high probability, but it's a tight channel, it's a strong trend day, small pullback, bear trend day. The pullbacks are lasting a while, but they're not very big compared to the range. So my stop is not going above this bar, it's going above here. So that's my first answer to you is I would use tight stop. And there's nothing wrong with using it. I would use a wide stop. There's nothing wrong with using a tight stop. Maybe you sell below the second entry buy, and one way to do it is just short here. And if instead this bar is a bull bar and stops you out, and you get another entry, a wedge or another decent bear signal bar, let's pretend you're trading one contract or however many, you double your position on the next. So maybe on this one you trade a half size and then you double on the next. But as far as, I just think it's easier to use a wide stop. It's easier to make the math work. And if I was trading really small, I would sell below here, put my stop up here, and I would plan on going for 1 times my risk initially, maybe 2 times initially. And I'd look, to scalp out on actual risk, but really, I try and trade always in, so I try and get out when the move weakens. So if I went short here, by this bar, maybe down here, I'd move my stops up here, and then, where would I get out? Very tight channel, so first up should fail. Do I get out here? Maybe. I think it's okay to get out here. It's great risk reward. You made quite a bit compared to the risk. But if I did get out here, I'd have to get short again here. And by, once again, if I sell, my stop's very far away. That's just nature of it. I probably wouldn't put it all the way up here, but I'd certainly put it quite a few points above the moving average just in case. And then I'd tighten my stop, maybe on this close, maybe this close up to here. Do I get out here? Probably not. Should get a second reversal down. And once again, I'd tighten my stop. But if I sold here, stop goes up here. And now we're starting to get consecutive buy climaxes. Again, if I sold here, stop up here. And if I was still short from over here, then by this point, I need to get out above. It's 3 pushes down at the spiking channel. 1, 2, 3. So probably okay to get out. So I hope I'm answering this person's question. And let me try to do a better job with that. Okay, so what's the difference between a tight and broad channel? Let's start there. Well, first, let me say this. Everything, I think of this as 2 things. I think of a breakout as a breakout, a really strong trend. It's the strongest type of trend or phase of a trend. It's this bar right here. That's what I think when I think of a breakout. I think of, okay, I can only sell at that exact moment. That's what I think of when I think of a breakout. Everything else, I think of a channel. I don't care if it's a trading range, if it's a tight channel where it's, like that on the September the 9th, what I just showed y'all. I think of them all as channels, and the reason I do that is because they all behave like channels. They all behave the same way. They're just slightly different, you know. So let's start with that. Now let's categorize what are characteristics of a broad channel. Broad channels have very disappointing pullbacks. Let's find one first. I can move my mouse here. There we go. I like that one. We had a good one earlier. Here we go. Here's a classic example of a trading range / broad channel. Little extreme, but it proves my point. So bull breakout, always in long, stop goes down here. Get a very deep pullback. Makes you think the market's turned always in short, and we test back up. Deep pullback, test back up. Deep pullback, test back up. Broad channels have really deep pullbacks, and they're usually, I'd say, well below 50%. And after, this is kind of a special day, but usually after, let's say if you're in a bull, I'm trying to find, here's a decent, this is a pretty good, this is kind of a Broadway channel. So usually you get bear bars, and then you get bad follow through, and you get tails on the bottom for broad bear channels. Pullbacks are deep, they last too many bars, they always make you wonder if the trend's reversed. So there's all sorts of characteristics. And usually how they form is just about everything's a spike in channel type of trend. Spike, channel, spike, pullback, channel, spike, pullback, channel, spike, pullback, channel up. So usually just about everything channels. The question is, it's usually better to classify it as something else. So a lot of times when you get a strong spike, and a lot of times you get a strong spike, you get a channel. Other times you get a type of trending trading range day where you get a spike, maybe you get a spike down and then you go sideways, and instead of forming a channel, you go back into the upper range, or you try and get in the upper range. That happens quite a bit. A good example was yesterday. We get a, kind of arguably a spike, it's a tight channel, pull back, and then we get another bear breakout, tight channel, and another bear breakout. A lot of times trading range days, they get consecutive breakouts. So sideways, they go down, sideways, breakout, and a lot of times the first clear breakout doesn't close the gap, and then you go sideways, you get another clear breakout. Or so I hope that makes sense. So basically, a tight trading range is a broader channel. It's a weaker, broader channel. I know it sounds really weird me saying that, but that's what it is. It's the broadest type of channel you can have is a trading range. It's the flattest. Think about it. The more broad the channel, the flatter the channel. So that means trading range. Trading range is basically just a horizontal channel. Channel is anything with two lines in it, up or down. Anything that can be contained within two lines. A wedge is a channel. So real quick, let's talk about wedges. Well, one of the characteristics of a wedge is that the gaps close after every move. So maybe you get a push down, you get a pullback. Well, yeah, that'll work. Push down, then you get a pullback, you get a second push down. Well, a lot of times the second push down closes the gap. There's an easy example on the sorry, kind of thinking for a second. Okay. I think I'm right on this. So, arguably a wedge, first, second, third. Why? Well, I think this gap will close. Al does too, and along with many others. If this gap closes, and then we get another leg up. So there's a couple factors. Strong enough breakout for a second leg, we got a second leg. But it's a strong enough breakout again for a third leg, we got a third leg. So 1, 2, and 3. If this gap closes, that means if we go above to a new high after that, we'll probably close the gap. And that's what wedges do. Wedges very often close gaps. You know, that's why wedges work. You get a bear breakout, pull back, the gap over here closes. Then you get another breakout, but because this gap closed, it's probably going to close again. Now, I'm running out of time, and I'll try and cover a lot more of this, but so for now, I'll try to make a part 2 of this and kind of collect my thoughts more. Channels, I'll discuss real quick. Channels usually, the reason you get a lot of times a high 4 or a low 4, and you know, a high 4 like this, even though this really isn't a high 4, but it's kind of is that a lot of times when you get a tight channel, a lot of times traders, they want some sort of break of the channel or a strong breakout. And I mean that in 2 different ways. So a bear channel, they want a bear breakout below the bear channel to signify that it's getting parabolic and climactic, so they need to get out. Or they want a strong breakout so they can sell and then get out and test back down. In other words, like here, strong bull breakout, a very deep pullback, and then test the new high. Or here, you know, this is kind of consecutive bottoms. It's basically you can call it a high 4. So bear breakout, second leg down, we tried to form a double bottom, and instead of forming a wedge, we got another strong bear breakout. Now, usually when you get these kind of consecutive sell climaxes in a trading range day, a lot of times it forms exhaustion. Now, but when you get strong bars like this, a lot of times you get second leg down. A second leg down. So, you know, here's 2 legs down, tried to bottom, bear breakout, make it a second leg down to a new low. But instead, when you get 3 bars up, usually kind of bears get really nervous, they exit, and they start buying. A lot of traders will start buying here knowing that, well, gee, there might be a second leg down to here, but if I put a stop down here, somewhere at this low, I probably won't get stopped out. So, biggest thing, trading tight channels, trading ranges, traders using wide stops. You know, so I'd highly recommend wide stops trading small. And to answer your question about, yes, tight channels, if you look far enough to the left, there'll always be some support or resistance level there. That's true. You know, that's because trends usually break, you've heard Al say it, trends usually break through all, or, you know, he basically says most support and resistance fails to break to stop a trend, yet all trends stop at support or resistance. So, okay, let's look at that. Well, we gapped up, we tested up to a major high over here, and then we started to fail. So we failed at resistance. We're trading down. We had support here. We broke strongly below it. We broke below back into this low. Could not, you know, we couldn't stop here. We broke below the close of yesterday, and we had to fall all the way down to here. Now, whether that's, you know, somewhere over here, doesn't matter. But it broke through support. All right, I'm kind of running out of time. So let me see if I can partly answer this next question really fast. And I'll try and take more time later in the day to answer it. Yeah, I'm gonna have to wait on that. Yeah, I'm not gonna have time to answer that. Alright, well, I hope this video is helpful. And again, I'll try and make a part 2 and discuss more, but just post comments below if you anyone has any questions, or post in the YouTube section of the comments of this video. Alright, thanks.